All right, welcome to History of Money. Professor Barth here, history professor at Arizona State University. All right, we are at lecture 36. Part A, we're going to take a look at the Federal Reserve in the 1970s and in the 1980s. Part B, big lecture, Greenspan era, financial crisis 2008, the coronavirus panic of 2020. And then Part C, the post-gold era, unanchored capitalism and the power of big finance. I'm just going to encapsulate different trends that one can observe since 1971. What has happened to the economy? What's happened to the financial sector? Okay, so when we last spoke, Nixon has closed the gold window. He didn't inform any of the Bretton Woods countries or even some of the members of his own cabinet, and so it has been called by historians the Nixon shock. Suspends convertibility of the dollar into gold. Formerly, the gold price was $35 an ounce. U.S. will no longer honor that. And now floating exchange rates replace the fixed exchange rates from the Bretton Woods era. Nevertheless, the dollar remained the world's reserve currency. What proceeds in the 1970s is a crisis in the U.S. dollar. And the chairman during this period is a man named Arthur Burns. Arthur Burns, pictured here, you'll often see him in photographs with a pipe in his mouth. Arthur Burns was a Keynesian economist, as were most economists in those days. He had some Friedmanites and other people in the Chicago school, but Keynesian economics is the rule of the day. And Arthur Burns, as such, believes that you can't really have moderate to high inflation and high unemployment at the same time. The 1970s will throw him, as well as a lot of other Keynesians, off guard. Now, Richard Nixon, early in Arthur Burns' tenure as Federal Reserve Chairman, had quite an interesting relationship with the chairman. First of all, Burns opposed Nixon's closing of the gold window. He thought it was a bad move, and nonetheless, he told Nixon that he would fully cooperate with his executive order. Nixon also placed pressure on Arthur Burns to cut interest rates and to keep interest rates relatively low prior to the 1972 presidential election. Low interest rates, usually at least in the short term, will lead to more economic growth, even if it has bad consequences later. And so presidents historically prefer interest rates to be low on the eve of an election, out of the thought, not unfounded, that a booming economy will help their re-election chances. Arthur Burns complied with Nixon's request. And so in the early 1970s, you have an expansive monetary policy. The link was cut between the dollar and gold. Price controls instituted by Richard Nixon in 1971 into 1972 and even into 1973. Here's the effective funds rate. And you'll see this rate cut in 1970 is what spurred the run on the dollar in the summer of 1971. Burns raises rates a little bit in the latter half of 1971, but then cuts them in the final quarter of that year and keeps them relatively low through 1972. By the way, in this lecture, as well as parts B and C, you'll see a lot of graphs that say Fred. Okay, you may be asking, who is Fred? This is the Federal Reserve economic data. Okay, it's from the St. Louis Fed website. It's actually a really great website if you're looking for hard data. You can really find any economic data you want, and you can plug into the years customizable dates, which is very convenient, especially for making a PowerPoint. So rate cuts. Now, what happened? Inflation. And look at the inflation rate. From the late 1960s through 1971, we're looking at about 4 to 6% inflation. Now, 6% inflation was enough to cause a run on the dollar before, but look at this. Look what happens to inflation beginning in early 1972. It soars from 3.5% to 11% by early 1974. 11% inflation rate. That is incredibly high. That means that if you had saved money early in 1972 and left it in a savings account and didn't touch it, it was now, between 1972 and 1973, lost 6% of its value. And then between 1973 and 1974, lost 11% of its value. That is quite a high level of devaluation. The price of gold went through the roof in the first half of the 1970s. The price of gold toward the end of 1971 was around $40, $45 an ounce in dollars. Now again, the government is no longer redeeming Federal Reserve notes for gold, but you still have a private gold market. And just like today, there's a gold market today. Look at that, from $40 to just shy of $200 by the end of 1974. That's a huge jump in the price of gold. Well, Burns responds to this spike in inflation by, frankly, doing the right thing, raising interest rates. And he raises them quite substantially. Interest rates, the federal funds rate, reaches double digits halfway through 1973 and almost reaches 13%, which is extraordinarily high, toward the end of 1974. I'll give a little context. Throughout the 2010s, the federal funds rate in this country has been a fraction of 1% through most of the 2010s until after, from 2018 onward, it's gone up a tiny little bit. Now it's back down to 0.25%. But through most of the 2010s, it was under 1%. Here we're talking double-digit federal funds rate. Well, there he is, Arthur Burns. This causes a recession. You tighten credit, jobs are going to be lost. Look at the unemployment rate. Unemployment rate goes up to, by early 1975, goes up to 9%. There's the stock market. In 1974 and 1975, the stock market lost a lot of value. Went down to 3,000. This is the Dow Jones, from a peak of 8,000 in 1965. So basically, all of the gains made in the Dow Jones between the mid-1950s, all of the gains made since the mid-1950s have been erased by the mid-1970s in the Dow Jones Index. So, what does Burns do? Burns replies by cutting rates again. Okay? He says, whoa, I moved too fast here. And he cuts rates quite dramatically from 13%, that high, in 1975, and brings it down to 5% and keeps it at that level through the end of 1977. What happens to inflation? Well, when Burns spiked those interest rates up to 13%, inflation went down. Inflation went down to 6%. Now, 6% inflation is still pretty bad. Like, if we had 6% inflation today, it would be seen as, whoa, that's really way too much. But 6% inflation is as bad as 11%. But because Burns cut rates in response to the stock market, unemployment, remember, he's a Keynesian. Oh, okay, unemployment's up. Let me lower interest rates. Maybe a little, maybe inflation isn't that bad of a thing anyhow, and that will bring unemployment back down. So inflation goes up again beginning in 1976. 6%, then 7%, 8%, 9% inflation by early 1978. Well, what happens to unemployment? Unemployment doesn't really get that much better. Yes, it peaked at 9% unemployment, but it's still just hanging around over 6% unemployment. 6% unemployment is a very good economy, okay? Usually full employment, you're looking at like maybe 3% unemployment. You're always going to have some unemployment. Some people just won't work. But if it's too far above 4% unemployment, that's a bit high, okay? That's too high. You're talking about people who want to work but can't find jobs. So unemployment really is still quite high, especially look at unemployment in the late 1960s. You had full employment right there. That's quite a bit higher. This is what economists call stagflation. Stagflation, where inflation is high and unemployment is high. Now, this appeared to repudiate Keynesian orthodoxy, which said, look, deficit spending, inflation, you're not going to have unemployment. But in the 1970s, you did. You had high inflation, high unemployment. Not only that, but it seemed to track. Right? Here's the inflation, it's going up, and then a little bit later, unemployment going up. Inflation goes down, unemployment goes down. Inflation goes up, unemployment goes up. Okay? And this really puts Burns and other Keynesians in this strange predicament where their theory, their economic philosophy, isn't working. And here's the Dow Jones. By 1978, the Dow Jones is still doing very poorly. Okay? It's a little bit of a climb, but then it's right back down again. And so Burns doesn't know what to do. He's out of tools. Burns leaves in early 1978. He's replaced by another chairman who's only there for a year, William Miller. Not important. Yeah, look at this. Time Magazine, is this slump necessary? Money chief Arthur Burns, facing an economy on the brink. In the late 1970s, there's a lot of pessimism about the U.S. economy. I mean, again, look at the Dow here. The Dow is lower than it was in the 1950s, okay? The U.S. is facing a lot of economic competition from Europe, which has fully recovered now, from World War II, from Japan especially. Japan's really rising in the 1970s economically. And there's a sense that the U.S. perhaps has peaked. Maybe the U.S. empire has peaked, and now it's just all decline from here on out. Actually, if you talk to a baby boomer and ask him or her, what was your outlook on the future of the United States, back in the 1970s when you were in your early 20s? And I guarantee you, they're going to tell you it was a pretty pessimistic time. Things weren't looking so good. This is the context, by the way, in which Congress amended the Federal Reserve Act. Not something Congress does very often. 1977, Congress said, okay, we didn't specify this before in 1913, but just to make it clear, you have a dual mandate, Federal Reserve, to strive for maximum employment and stable prices. And so that is the so-called dual mandate, and it's still in place today. That was Congress amended the Federal Reserve Act because at the time, under Arthur Burns, we had high unemployment and very unstable prices. And so that dual mandate was put in there as a corrective to make clear to the Fed what their goals ought to be. Burns, toward the end of his tenure, and then his successor raised rates a bit to 10%. And again, by our standard today, 10% is just off the charts, high interest rates. It wasn't enough to stop the inflation. The inflation continues to climb. Confidence in the dollar is falling. Look at this. By beginning, especially in 1978, okay, and then 1979 into early 1980, inflation is back in the double digits. And it peaks in March 1980. Jimmy Carter is still president. Inflation peaked in March of 1980 at 15%. 15%. It's astronomical inflation. The price of gold just went berserk. Keep in mind, in 1971, the official price of gold, according to the United States government, was $35 an ounce. By early 1980, gold is selling at more than $800 an ounce. $800 an ounce from $35 an ounce less than 10 years ago. Ronald Reagan runs for president in 1980 on a platform of change. He runs an optimistic message. Carter, somewhat like Herbert Hoover, is a man that, again, he didn't ask for this, perceived as weak, unable to get a handle on things. Reagan brings a new philosophy of government to the table, more of a free market solution of deregulation, lowering taxes. And he runs an optimistic campaign, Morning in America. And actually, the slogan, Make America Great Again, dates to 1980. It was adopted by the Reagan campaign, then later made famous and fully embraced by the Trump campaign in 2015 and 2016. But you can see, I mean, the country was like, yes, please. Reagan wins in a landslide in 1980. Now, for our purposes, the Fed chair here is most important. Paul Volcker was chairman of the Fed from August 1979 until August of 1987. Now, you'll notice the dates there. He was actually put into that position under Jimmy Carter. Volcker is usually associated with Reagan, but it's Carter who puts him there. And Volcker's main objective is to put a stop to this inflation. And it's a crisis. I mean, it may get worse. What if we reach 20% inflation? What if we reach 40, 50, 60, 100% inflation? Now, that, as you know, doesn't end up happening. But in 1980, there's no guarantee that that's not going to happen. It's happened in other countries. And so there's a real fear here. This is a crisis in the dollar. And so Volcker comes at it with a very tight money policy. We need high interest rates, and we need pretty extreme high interest rates right now to stop the inflation. There he is. You'll see in a lot of the photographs of that day, he has a cigar in his mouth. Back then in public buildings, and even when giving testimony to Congress, you could smoke a cigar while you were giving that testimony. There was an FOMC meeting in October 1979, and at that meeting, they decided, okay, we've really just got to spike these rates. And between October of 1979 and April 1980, the federal funds rate went from 11.5% to 17.5%. Tried that, then cut it, and then the inflation is still going out of control, and so they raised it even higher, reaching a peak by June of 1981 of 20%. 20% federal funds rate. 20%. And it had huge consequences. You can't raise interest rates to that high of a level without causing a contraction. And so look at that, 1979, if you thought this was bad in 1977, 1978, it fell even further. Now, by 1981, in the early months and first year of the Reagan administration, the Dow Jones is at like 2250, okay? Dow Jones that's a huge drop since 1965. Look at that. Unemployment is now in the double digits. Paul Volcker was very, very unpopular, and actually Ronald Reagan, early in his administration, was very unpopular too. I mean, you see the landslide here. By early 1982, a lot of the country is very fed up, and has become disillusioned by Ronald Reagan. Look at the unemployment rate. It climbs from summer of 1981 to summer of 1982 from 7% to almost 11%. The high interest rates made it very, very difficult to obtain a car or home loan. The prime rate, which is even higher than the federal funds rate, reached almost 22%. That's the rate that you and I borrow. I mean, I wouldn't. Would you buy a house with a 22% interest rate? Heck no, man. I'm not. I'll rent. Thank you very much. So the construction sector did very, very poorly. Construction worker unemployment reached 22%. 22% for construction worker unemployment. All the industrial sectors did poorly. Manufacturing shed over 1 million jobs. between 1980 and 1982. The automotive industry, which was already really struggling because U.S. automakers were making bad product in the late 1970s and early 1980s. U.S. automobiles today have become a lot better, but back in those days they were just crap. And Japanese competition, foreign competition was outdoing them. So the automobile industry was already struggling as it was, but between 1980 and 1982, auto plants closing, the unemployment rate for auto workers rose from 4% in 1978 to 24% by the end of 1982. So things are looking really bad. Farming also did very poorly, and in fact, this was actually 1979, before rates were 20%. This is when rates were 11%. Farmers stormed Washington, D.C. in their tractors and at one point blockaded the Eccles building, the Federal Reserve building, to protest the high interest rates. So pretty dramatic. There's someone wearing a Jimmy Carter mask. So, the Federal Reserve, not very popular at this time. Well, look at those high rates. What was the effect? Inflation went down. It worked. It was just very painful, right? For about a year and a half, maybe 2 years, quite painful economically. But by the end of 1982, inflation had been brought down to 3%. Okay, and it remained between 2 and 4% through the rest of Paul Volcker's tenure at the Federal Reserve. And so you actually have to look at it, say, okay, he stopped the inflation. The gold price calmed down from a peak of over 800 in 1979 and 1980. The gold price settled at around $300 to $400 an ounce. If you had bought gold at that price, you lost a lot of money. And Volcker felt confident enough by 1982 to begin lowering rates. Now, this is still 10% right here. So midway through 1982, you still have double-digit federal funds rate. But, and he has to raise it a little bit here. And, it never falls below 5% under Paul Volcker. Never falls below 5%. Nevertheless, he's able to lower it. And the economy gets moving again. Unemployment falls from double digits to 7%, hangs around that area. Again, it would still be seen as too high. You could say maybe this is an uneven recovery. But look at the stock market. Dow Jones, from a low of 2,200 points, Dow Jones recovers. This is through the rest of Reagan's administration. Okay, Dow Jones basically before a brief stock market crash in 1987, which we won't go into because we have to move on. That's almost tripling in the stock market. Reagan, Volcker. The mood shifted in 1983, 1984, and Reagan became very popular again. Look at the presidential election in 1984. Absolute landslide in favor of Ronald Reagan. As for Reagan, large tax cuts, booming economy after 1982, and yet major increases in federal spending, especially military spending. And so actually deficit spending under Ronald Reagan increases a lot. Here's a chart of the U.S. national debt in terms of trillions of dollars. Under Ronald Reagan, for the first time, we reach $1 trillion national debt. And by the time he leaves office, we're approaching $3 trillion of national debt. And then by the end of George H.W. Bush's administration, who was Reagan's vice president, we're over $4 trillion of national debt. Okay, the size of the scope of government, even though you had deregulation and tax cuts, the federal government was still very large, still lots of spending. And so Reagan, good rhetoric, solid rhetoric in a lot of respects, but the results are more of a mixed bag. And in fact, actually, as the national debt rose, and interest rates, while Volcker was able to cut them, this is still fairly high. Right? It's over 5%, 7%, close to 10%. You saw a substantial rise in federal interest costs on the national debt. So it's a bit of a mixed bag. Paul Volcker, his tenure ends in August of 1987, and a new man takes the helm. Alan Greenspan, the new Mr. Dollar. Alan Greenspan. So for part B of this lecture, we'll take a look at Greenspan, and we'll go all the way up to the present. Okay, it's going to be just a good, solid survey. So looking forward to that. See you there. Bye.